Okay, let's jump right into this explainer and look at the actual financial blueprint for one of life's absolute biggest goals, retiring rich. We're going to break down the source material to uncover the real strategies that help ordinary people build truly extraordinary retirement wealth. It's a fascinating subject, honestly, because for most of us, achieving this isn't about winning the lottery or getting some massive inheritance or even earning $1 million salary. It's entirely about what you do with your money in the decades leading up to that final day of work.
Just imagine waking up at 65 and never having to work for money again. Your house is completely paid for, your investments are generating steady income, and you have the absolute freedom to travel and spend time with your family without constantly checking your bank balance. Sounds great, right? Now imagine the complete opposite. You hit retirement age, but you realize you simply can't afford to stop working. You've still got crushing debt, your savings are practically non-existent, and every unexpected expense brings this massive wave of anxiety. Well, those two radically different futures are dictated by the financial decisions we are making right now.
So, here is our roadmap. Number 1, the power of time. 2, optimizing your retirement accounts. 3, investing versus just saving. 4, protecting your future wealth. And finally, the rules for retiring rich.
Let's start with Section 1, the power of time.
The foundation of everything we're discussing today is that your absolute greatest financial asset isn't a massive salary. It's the decades you have ahead of you. Compound growth is basically a giant snowball effect. For example, if you start investing just a few $100s a month at age 25, historically, that can balloon to over $1 million by 65. That vastly outperforms someone who invests triple that amount but waits until they're 45 to start. When your investments generate returns and those returns stay invested, you start earning future returns on both your original money and your previous gains. Your money is literally working for your money. Now, if you are starting at 45, do not use a late start as an excuse to just never start. Your strategy might need to be a bit more aggressive, but action today always beats regret tomorrow.
Now, before you can start building this wealth, you have to sit down and ask yourself exactly how much money future you actually needs to retire. Retirement planning becomes so much more powerful when this vague dream becomes a hard, definitive number. People really love to throw around a random $1 million target. I mean, it sounds great, right? It's a nice round number, but is it actually accurate for you? The reality is that someone who expects to spend $40,000 a year needs a completely different retirement target than someone who plans to spend $150,000 a year. You can't just pick a random number out of thin air and hope for the best. Instead, you've got to work backward from the actual life you want. You need to turn specific lifestyle factors into a concrete monthly investment goal. We're talking about factoring in your expected lifestyle, your housing expenses, those ever-important healthcare costs, taxes, inflation, and of course, how long your money actually needs to last. Once you define all of these, that vague dream suddenly becomes a very real, highly actionable target.
Moving on to Section 2, optimize your retirement accounts.
So knowing your number is great, but you need the right vehicles to actually get you there. For millions of people, the 401k is the primary wealth-building tool. Listen, if you have a workplace plan and your employer offers a match, they are essentially offering you free money whenever you contribute. Failing to contribute enough to grab that full match means you are literally leaving part of your own compensation on the table. Plus, as your income grows throughout your career, you really should be gradually increasing those contributions. Even just bumping it up by 1% makes a massive difference over a few decades.
Also, keeping more of what you earn through tax advantages is just as vital as your actual investment returns. Depending on your eligibility, a traditional IRA might offer you some great tax benefits today, while a Roth IRA can potentially give you tax-free qualified withdrawals in retirement. So which one's better? Well, it entirely depends on your individual situation, your current income, what you expect in the future, and your overall tax position. But the big takeaway here is that minimizing your tax burden is absolutely critical to maximizing your long-term wealth.
All right, Section 3, investing versus just saving.
Now that we have the accounts set up, we really have to talk about what actually goes inside them. Because believe it or not, just saving cash in a standard bank account is a massive financial risk. The silent killer of savings is inflation. It quietly destroys your purchasing power over the decades while your cash just sits there doing perfectly nothing. Historically speaking, inflation cuts the purchasing power of cash in half roughly every 20 to 25 years. Just imagine your money resting there in the bank while the cost of housing, groceries, healthcare, and gas continuously rises year after year. Over time, the actual real-world value of your cash drops significantly.
To beat that inflation, you absolutely must invest in assets designed to provide growth aligned with your timeline. And that means understanding which risks are actually worth taking. The goal here isn't to be reckless. It's to build a solid portfolio of stocks, bonds, or diversified funds that can actually outpace the rising cost of living. Building retirement wealth isn't about avoiding every single risk out there. It's about managing risk intelligently so your money can actually grow.
But on the flip side, you really must avoid concentration risk. Imagine putting your entire life savings into one single company. If it becomes a global giant, sure, you make an absolute fortune. But if it collapses, your retirement collapses right along with it. Diversification across mutual funds or ETFs won't guarantee profits, and it won't entirely prevent market losses during a downturn, but it fundamentally prevents one single bad stock from totally wiping out your future.
Which brings us to Section 4, Protecting Your Future Wealth.
Okay, so we've laid the foundation, we've built the framing of your financial house, but now we need to install a security system to protect it from everyday threats. The absolute wealthiest people automate their path to wealth. You need to make investing a non-negotiable bill that you pay to your future self the exact moment your paycheck hits. It's a highly effective, super simple three-step process. Step 1, the paycheck arrives. Step 2, the contribution happens automatically. And Step 3, you just go live your life. No monthly internal debate, no trying to time the perfect market moment. Motivation eventually fades, but automated systems, they stick around for decades.
Here's another harsh truth. You cannot build wealth if your money is constantly fighting itself. You have got to destroy high-interest consumer debt so those dollars can start working for your future instead of against it. Look, a mortgage is one thing, but revolving, super expensive credit card debt or personal loans, they will absolutely consume the very income you need to be investing. Every single dollar you free up from unnecessary interest is a dollar that can finally go to work for you.
And please beware of lifestyle inflation. This is that classic trap where you get a raise and immediately buy a better car. Then another promotion leads to a bigger house and way more expensive vacations. Years go by, you're earning twice as much as you used to, but you still have absolutely nothing left over to invest. Enjoying your hard-earned money isn't wrong at all, but whenever your income rises, you've got to ensure you increase your investments before you increase your lifestyle. You've got to give your future self a raise too.
Now, true retirement security comes from multiple sources of income. You want to ensure you aren't completely dependent on just one single financial stream. A genuinely wealthy retirement might combine a 401k, Social Security, maybe some rental properties, and dividend interest. The more diversified your income streams are, the safer your retirement ultimately becomes.
And definitely don't forget to protect your pile of money from reality. People love planning for those long retirement vacations, but healthcare is the massive expense most folks totally underestimate. Your plan has to account for insurance, Medicare-related costs, long-term care, and all those out-of-pocket medical expenses. Your portfolio isn't successful just because it hit a big number. It's successful because it can actually survive the very real, very expensive reality of getting older.
Finally, Section 5, Rules for Retiring Rich.
Let's bring this all together into a master playbook you can literally start using today. If you remember nothing else from this explainer, you might want to screenshot these 7 golden rules. Ready? Start early. Know your exact target. Use your tax-advantaged accounts smartly. Invest consistently while staying diversified. Destroy that high-interest debt. Avoid lifestyle inflation as your income grows. And crucially, stay invested long enough to let compounding actually work its magic. Retiring rich is really just about avoiding major mistakes while making good, solid financial decisions automatically, decade after decade.
You know what's really interesting? Retiring rich isn't about overnight success. It's the quiet, repetitive choices you make today that dictate future you's freedom. The world loves a flashy, get-rich-quick success story. But the truth is, you might not notice the difference next month or even next year. But decades from now, these quiet, steady contributions will be the entire difference between financial survival and total financial freedom.
So, your future is being built right now with every single dollar you earn, spend, and invest. The goal isn't just to retire, it's to retire with choices. We're all going to eventually stop working. The only real question is whether you'll do it on your own terms or because you literally have no other option. So I'll leave you with this. What is the very first step you will take today so that future you has that choice? Thanks for joining me on this explainer and keep building that blueprint.